If you haven't been living under a rock, you've probably heard a little something about the upcoming recession. You may have seen an article like this, or like this, but then you may have also seen an article like this. We've been in the longest bull run in history, but now all of a sudden there's all these cries of a recession coming. Now the reason a recession is looking more likely than ever to happen soon is that because there is an inverted yield bond curve happening. Basically what's going on is the long-term bond yields are becoming lower than the short-term bond yields for the first time since the month before the Great Recession. So this is one of the greatest indicators that a recession is coming. There's also been other signs such as a global slowdown in growth, and lots of companies are laying off tons of workers. This could all sound very scary and intimidating, so in this video I'm going to be giving you 5 tips and strategies that you should do to prepare for the next recession. I also did a video, if you haven't seen already, on the top newbie investing mistakes, so if you haven't seen that yet, the notification will be in one of these 2 corners if you're on desktop, and the link will be in the description as well. That video goes hand in hand with this one. The first thing is going to be to make sure that you have a diversified portfolio. Billionaire Mark Cuban has said that diversification is for idiots. However, I think it's definitely necessary to help manage your risk. Diversification will also hopefully beat that volatility that we're having right now in the market, so that way you'll be much safer. Making sure that your eggs are not in one basket and you have your money spread out into different assets will ensure that you won't get totally hurt by the next recession. For example, if you had all your money in Apple stock, well, Apple is one of the largest companies on the Dow, and with the Dow coming crashing down, Apple will be sure to fall as well. However, if you had your money spread out into different assets such as bonds, REITs, stocks, and had some cash in the bank, that would be much more advantageous. Keep in mind that REITs are more so dependent on the real estate market and not so much the stock market. If you'll take a look at rent prices during a recession, historically it's actually stayed pretty much exactly the same, meaning these funds and properties, as long as they keep getting their rent, they will continue to pay out dividends. But when it comes to long-term investing, you shouldn't have to worry about little ups and downs in the market, which leads me to number 2, is that you are in it for the long haul. It's all about time in the market as opposed to timing the market. People make a ton of money during recessions. You shouldn't worry about what your portfolio is doing in the next month, the next 6 months. You are in it for the long term. You are looking in the big picture. So what you should do during a recession, and really any time at all, is to average in your costs in the market. Personally, what I do is I'll actually buy a few shares of a company every single solitary month on the first of the month, so that way my position and my price is averaged, and I'm not worried about what the market will do, and I'm not worried about big swings. For example, let's say you bought stock at 40 bucks, you're all excited, you're gonna make some money, and then all of a sudden a recession happens and the stock drops to 20 bucks. Well, then the strategy is to go ahead and buy shares at $20, so that way your average position is 30 bucks. This way you're at least somewhat protected, because if the shares did go ahead and drop even further, then you wouldn't be as hurt because you actually bought it around 30 bucks as opposed to 40. And on the flip side, you're also protected, because then if the market does come back, it's starting to rise, stocks are going up, you actually will be in at 30 bucks, so you don't have to wait to break even at 40. Buying in intervals and setting aside money every single month to buy shares not only helps me average out my position, but it's a great way to save cash and stack away your money. We've had some massive swings in the market. Just at the time of filming this, the other day the Dow was down 800 points, which was the 4th largest drop in history. So averaging out your position will protect you from any of these massive swings, which will probably be certain to happen again and again and again. Part of this has also been due to the trade with the US and China. You've probably seen some news on that as well. So what has happened many times is that whenever trade talks look good, it looks like US and China are going to strike a deal, the market will go massively swinging upwards, tons of bulls will come rushing in, but then on the flip side, if it looks bad and trade talks are not going so good, the market can crash with no tomorrow. This volatility could be quite scary, but going back to number 1, having that diversification and of course going for that long-term play and having that mindset will protect you from those massive swings. Which also leads me to number 3, which is don't listen to the hype in the media and the headlines, and don't shoot yourself in the foot and sell your positions because you're scared. The truth is, no one really knows if a recession is coming. It might look like it because of the bond yield inversion. It might look like it because it's been 10 years since the Great Recession. It might look like it, but it might not truly happen. You also got to keep in mind that tons of laws and regulations were put into place so that way something like the 2008 crash wouldn't happen again, the actual specific reason why it happened. But just because you see one headline, one tweet, your stock goes down for the day, don't panic and don't sell. This is one of the biggest mistakes people could make. They end up regretting it because all they had to do was hold on just a little bit more and they would have been perfectly fine. The headlines could be pretty scary, but remember, it's their job to make money, get views, and get people to click on their articles. With that being said, also don't listen to these so-called gurus who are telling you to put your money in a certain place. If you've done your research and you've looked at the fundamentals of a company, then the company will be strong and will survive the recession. This also leads me to number 4, which is having cash in the bank. You may have heard the saying that cash is king, and in the case of a recession, is definitely a massive advantage. You want to have an emergency fund ready 3 to 6 months, if you can, even a year of expenses, because you want to be protected. Now, you shouldn't just be making an emergency fund because there might be a recession looming. You should be doing this anyways. Having this extra cash will also be very beneficial because you'll be able to scoop up all these companies at a very discounted price. People have made fortunes during a recession. You just take a look at some of these companies, what they did after the 2008 bubble. They went up literally hundreds of percentage points. Be prepared, have this cash ready to cover expenses because you don't know what will happen. You might feel safe and comfortable in your job, but anyone can get fired or laid off at any time. And with the rise of artificial intelligence and technology, you might be replaced with a robot by tomorrow. This is why it's so important to save money, and you have to do everything in your power to be able to save at least minimum 10% of your income. But in today's dollars and nowadays, that won't even slide. The fifth thing that you want to do is pay off all of your debt. If things are not looking good, you just got laid off, your portfolio is way down, the last thing that you want to be hit with is these high interest monthly payments on whatever you bought on credit. And then when you're not able to pay off this debt in the future, you'll just be dragged even further down into more debt and you'll be drowning in it. This is just pouring salt on the wound, and anything that you put on layaway or anything that you bought with credit, you want to try to get rid of it as soon as possible. And really, you shouldn't have had this boatload of debt in the first place, but if you are in it, you want to make the effort to pay it off. Especially that high interest debt that you might have, it will just keep adding up and snowball effect. On top of that, if you're hit with penalties and fees, that could really harm you. Now, it might sound impossible to pay off all of your debt, have an emergency fund, and have enough income left over to invest. That is why it's so important to work on a side hustle, bring in extra income, have as many streams of income as possible. This is crucial for making sure that you'll have a great future and building your wealth. I actually did a video on the 7 different streams of incomes that millionaires have. You can see that link in the description as well. It's important to be prepared, and you don't necessarily have to be paranoid, but don't be overly confident in what you're doing. Be sure to follow these 5 strategies and tips to get through the next recession. If you got value out of that video, if you enjoyed it, be sure to smash that like button. It just helps with the algorithm, so that way more people could see videos just like this. And if you haven't already and you want to see more videos, go ahead and subscribe to my channel. I post videos every single week for you to enjoy. And if you'd like to be notified, be sure to hit that little notification bell as well, so that way you're notified every time I get a new one. See you in the next video.